So apparently, those things were just so crazy that Zoom just didn't like him at all, and it just shut us down. So I guess those will just be between you and me.
Thank you so much for saying that you would show up and do this for me. I greatly appreciate it for sure.
My pleasure.
Yeah, yeah. Well, I am Makeba Evans, and this is a lunch and learn session that we are gracious enough to have our special guest, Art Wood, is going to explain the conventional home loan to us, the benefits of the loan and the process, and making sure you, as a consumer, have the information you need beforehand. Of course, consulting with your mortgage professional like Art. Here is the best way to get those questions answered. But for those of you who want some information and to be pointed in the right direction before you officially make that connection, that's what this conversation is about. So thank you, Art, for showing up.
My pleasure. That's the key is always showing up first, right? And you always have to show up for your clients and your partners and everything else. So happy to do so. Um, I'm thrilled to talk about conventional loans because it's 97% of the loans that I do.
Mhm.
Last year I closed 386 loans, and I for 102 million, and I think 98 million of the 102 million, or something like that, were conventional loans.
Okay.
Um, you typically have maybe five types of loans, and you get conventional, VA, then FHA and USDA, and then non-QM. And really, those are in order of kind of qualifications. So conventional requires a little higher qualification than FHA, and where FHA, I guess we kind of jump right in. Conventional loans, typically anybody that's a 700 credit score or better, I'm going to push towards that route is going to be conventional.
Okay.
And pros and cons, and I'm going to be talking a lot about FHA as well. It serves its purpose, but I generally will try. I will generally try to you know to push them where they need to be.
Mhm.
Um, but with conventional loans, one of the biggest things is your PMI will eventually fall off. With conventional, you pay PMI, which is private mortgage insurance, if you don't put down 20%.
Gotcha.
Okay. With FHA, you pay mortgage insurance regardless of what you put down. You could put 90% down and still have private mortgage insurance. Now,
Mhm.
with FHA, it will fall off. If you put down at least 10%, it will fall off in 11 years, come
Okay.
hell or high water. Okay. With conventional, then it will fall off whenever automatically it'll fall off when you hit 78% loan to value or 20%, 22% equity.
Mhm.
You can challenge it after 2 years if you feel like the house is appraised, or increased in value. So that is the probably the number one biggest thing. One of the reasons you don't typically want a conventional loan if you're below 700
Mhm.
is with conventional loans they're qualification based. The rates and the PMI are qualification based. So you could have an 800 credit score, low debt to income, and your PMI could be next to nothing. But if
Mhm.
but if you have a 680 credit score and your debt to income's a little high, then your PMI and your rate are going to be unsustainable. That is one of the big benefits with FHA is
Mhm.
really as long as you have a 640 or 660 credit score all the way up to 800, your rate's going to be the same,
Okay.
regardless. And your PMI is going to be the same. So again, if you take let's say a 750 credit score and you try to put them in an FHA loan, then their PMI is going to be much more than it would be with conventional, and it potentially would never fall off. So those are some of the big things. Primarily, it's primarily credit score driven. There are some guidelines. I actually think the guidelines for FHA are a little more strict. Like you always need 2 years tax returns. With
Mhm.
conventional, sometimes you can get away with 1 year tax returns if you're self-employed. Um, rates rates are pretty similar.
Mhm.
The funny thing is, quite honestly, just as an industry, a lender makes more money on an FHA loan than they do on a conventional loan. So you will find some lenders that try to, kind of specialize in that, try to push people more that way because, that's just not the way I operate. I think any good loan officer should put you in the program that best suits your situation.
Right.
Period. Just like a real estate agent, when somebody comes to you with a pre-qual letter for a $250,000 house, you don't go show them $400,000 houses.
Exactly.
That's not always what's best for them. Um, so those are the major things. The PMI. Now, the one thing again that FHA has in a negative sense that conventional doesn't is it has a funding fee. Is 1.75% of the loan size is going to be added to your loan. So
Right.
you just think about it. If it's a $100,000 loan, that's $1,750 that's going to be added to your loan, or $3,500 or something like that if it's a $200,000 loan.
Right.
So typically, that's a negative. But what I'm telling you, what FHA does, and again, I'm supposed to be talking about conventional, and I think you've got to talk about both of them back to back, pros and cons.
Right.
But FHA serves there is a large population of folks that have a 640, 660 credit score.
Yeah.
They also allow a little bit higher debt to income with FHA as well. So it is a great opportunity for somebody that is, not, maybe hasn't protected their credit as much as others have or whatnot, but it is a way to get them into a home loan, with a good loan, with a non-predatory loan like the old days.
Right.
And if we looked at the other ones, VA, you got to be a VA vet. Those are specific to kind of what your qualifications are. Where did you serve in the military? Did you qualify for that? USDA, you've got to live in the country. You got basically got to live in the sticks. And then the non-QM stuff are the stuff like bank statement loans and one day after foreclosure or one day after bankruptcy, and and obviously you're going to pay handily. Prepayment penalties, potentially higher interest rates. But again, it's an avenue for you to get a loan if you can't get it anywhere else. It's short of hard money. But again, my average credit score last year for my clients had, close to 386 loans. My average credit score for my clients was 755 last year.
Okay.
Which is great. I really had no idea.
Yeah.
I will say this. This has nothing to do with conventional loans or not. This is one of those words to the wise. Is I always tell people that with a good credit score and a good reputation, you can get just about anything you want in life.
True.
So what Makeba, what questions do you have maybe that I didn't touch on or that I should touch on or?
Well, in the industry, we're familiar with different terminology. So can you explain debt to income ratio?
I absolutely can explain debt to income. So we talk about a few things: LTV, we talk about DTI, we talk about PMI, and ARV. I mean, there's all these different things. So, and I get, because this is what I do all day long, every day, I get into a bad habit of just spouting those off. But PMI, private mortgage insurance, and what we talk. Actually, let me jump back to that real quick. In both cases, FHA and conventional, insurance is what it is, right? It protects the lender. They're lending you the money. So FHA is a federally backed loan, and so you're paying insurance. The same thing when you pay homeowners insurance, right? You don't need it till you need it.
Right.
So it is protecting the lender or against not paying your mortgage.
Right.
So you got to think that there's probably 99% of folks that pay their mortgage or not, whatever that number is. But that fund of mortgage insurance and funding fees will help those lenders that lent money and then got kind of screwed, if you will.
Right. Because the lenders don't want to own homes. That's not
right. Well, and the funny thing is that I looked at with a conventional loan when the new pricing first came out. It was like 2010, so it was like 10 years ago when the pricing came out. I looked, and the interest rate on a putting 5% down, 5, 10, 15% down was better than putting 20% down, which is weird. Everybody says put 20% down on conventional when you buy a house, conventional loan, which is not necessarily the case. So strike that from the record. You could get with as little as 3 to 3.5 to 5% down. But as I'm like, I sent back that rate sheet back in 2010. I'm going, y'all screwed this up. Send this back to me. And they're like, no, this is right. We verified it. And that's the way it is across all Fannie Mae and Freddie Mac, which are basically the godfathers of conventional loans. And what it was kind of explained to me was anything above 80%, there's PMI to protect them. So really, 80% loan to value with 20% down is the riskiest loan a conventional lender can provide, because there is no backup. There is no private mortgage insurance. It is all them.
Gotcha.
So I thought that was interesting.
Yeah.
So that is what PMI is. And again, you don't need it till you need it. Just kind of like when you have homeowners insurance, you're going to pay it. And if you never have a claim, you're going to feel like you wasted a lot of money. But when you do have a claim, you had it.
Just like car insurance. Yeah.
That's right. That's right. So you got PMI, debt to income. DTI is looking at what you owe versus what you make. And that is not what you owe in a grand sum, like, hey, I own $25,000 on my car, but my car payment is $500. Okay. So I'm going to look at all your monthly payments, and that's just on your credit report. Like your utilities are not on your credit report, right? So you're going to look at the most common are student loans. That's a whole, I could probably do a whole nother episode on that.
Right.
Student loans, car payments, installment loans, potentially collections, credit cards. Or what they call revolving accounts. So out of all those minimum payments that are listed on the credit report, let's say, and you're looking for a $1,500 house payment, you got a $500 car payment, and you got $500 in credit cards.
Mm-hmm.
What's $2,500? I had to think about that. That's $2,500 a month. Well, if you make 60 grand, let's all do the math, but divided by 12 is $5,000, right?
Yeah.
So now that's 50% debt to income, because you make $5,000, your debts are $2,500. Mm-hmm. So that's not guaranteed to go through conventional, but it might. At 50.0001, it will not go through conventional.
Gotcha.
FHA, you can actually get that up to generally 55 to 56% if it's a strong file. Mm-hmm. So that's where you when you're looking at, hey, do I qualify? First of all, you should always call me or another mortgage professional. Don't do it on your own. Let's get that pre-qualification letter. Let's get that pre-approval letter potentially, and go shop with confidence. But if you're sitting around going, oh, I wonder what my debt to income ratio is, just take all those things that you had to apply and have your Social Security number and credit pulled for. And those are the things. If you take student loans, all right, so I'm going to run over student loans real quick.
Yes, please.
Yeah. It's complicated.
Yeah.
And I'm just going to stick with the FHA and conventional. And I probably should just stick to conventional. But conventional is a little bit more flexible. FHA basically says, for the most part, 1% of your student loan balance. So for those overeducated folks, which is not me, I'm undereducated, I'm an underachiever. Then you have $100,000 in student loans, and that's immediately $1,000 a month in debt.
Right.
So I've met a lot of folks that have gone and gotten their master's, a PhD, all these different things, and they're doing things that I commend them for doing. They're social workers in schools or something, and they're making $60,000-$70,000 a year, and the student loans preclude them from getting a mortgage, right? Especially with FHA. So there is a caveat to that. If you do get a fixed payment, that's basically a finite period of time. Hey, if you pay this for 25 years, it will pay off your loan. But that ends up being about 1% anyway. So with conventional, they will allow an income-based repayment solution. So let's say you have that $100,000 in student loan debt, then you can basically take whatever that income. Let's say your income-based repayment plan is only $100 a month. Well, they only hit you with $100 a month. If you're in deferment, they're going to hit you for 1%. Okay. So it's confusing to say the least. But I have seen student loans wreck more than one mortgage, because and that's a whole other thing we can talk about later. But
right.
So anyway, so that's what your debt to income is. LTV, you don't have to worry so much about that. That's more your down payment. What do you owe versus what the house is worth? That's your loan to value. So those are. I hope that I did an okay job of explaining DTI.
You did. Thank you. Now, what are the loan limits for conventional loans?
I am so glad you asked. Right? I know this stuff. Check me That's another. Again, I'm doing a lot of believe it or not, VA doesn't have limits anymore, other than the fact of what your qualifications are, certificate of what your eligibility is. In FHA, the bigger cities, basically it's around 400,000. It's give or take, like maybe 412 or something like that.
Okay.
So anything below that, unless you get outside the big city, and then the loan amount's actually less. But then when you get to conventional, it's now, and they redo this every year. But now it's 548,250. So $548,250.
Okay.
Anything over that, and then the thing I didn't even mention was jumbo. Anything over that's jumbo.
Gotcha.
And subject to, I typically won't even do jumbo, unless it's a jumbo VA or something like that. It brings in a whole other world. And a lot of times, I hate to sell myself short, but a lot of times people that are best through jumbo are the banks that want your depository and investing relationship, like the Wells Fargos and the Chases of the world.
Mhm.
Yeah, because they can buy that. So,
Okay.
what else you got for me? Keep going. You're on a roll.
With conventional loans, share with me how long after foreclosure, how long after a bankruptcy?
Bankruptcy is 4 years, and foreclosure 7.
Okay.
So some other good details on that. I mean, because again, FHA is 3 and 2 and 3.
Okay. Okay.
So yeah, and now there's a caveat. If you lose your house to bankruptcy,
Mm.
if you include your house in the bankruptcy, it's actually only 4 years instead of 7.
Okay.
So those are good things to know. Keep going.
100% financing options with conventional loan products. It just depends on who the mortgage professional works for, whether that company offers such a product.
Well, so typically the 100% is typically yes. You will find some places that will, in certain areas like low income areas, they may cover that. A lot of times it's a 3% down first mortgage and then a silent second mortgage.
Yeah.
I don't want to get up on my soapbox, but I like, in my opinion, I like to achieve something.
Right.
And so it's kind of like in my, giving to charity, giving to your church, whatever else it is. If it were easy, everybody would do it. So, I think it's got to hurt sometimes a little bit. And
Yeah.
I think that helps you appreciate that house a little bit more when you like, hey, I've got a systematic savings system that I put together. Look what I did.
Yeah, disciplined enough to make the sacrifices, for sure.
That's right. I mean, if everybody could win the World Series, then it would take, without practice, without hard work, then it would take away what it would really mean.
Right.
So that's not a popular opinion, by the way, but
well, that was part 1 of our conventional home loan conversation. Art, thank you so much for sharing all of the information that you did. And I know our viewers are going to look forward to part 2. Can you tell everybody how to get in touch with you?
Absolutely, would love to. Again, my name is Art Wood. I am with the Art Wood Mortgage team with Goldwater Bank. And my telephone number is 678-534-5834. Again, 678-534-5834. And my email address is art.wood@goldwaterbank.com. And just use me as a resource. Whatever I can do to help, I'm happy to.
Perfect. And Art, what areas do you work in?
So that's a very good question. So, 95% of my business is all over the state of Georgia.
Okay.
Just period. But the nice thing about being with a bank is I can lend nationwide, with the exception of New York and Vermont, I believe. So random places. But so I mean, I've got a loan going in Pennsylvania now. I got one going in New Mexico right now, and Washington. So it's just nice to have that flexibility.
Yeah, definitely. A lot of lenders can't do that. So that is definitely something to share, because I get referrals all over. So that's a good thing to know.
Like referrals.
Yes.
We like referrals.
Well, I hope you enjoyed part 1 of the Conventional Home Loan series. Please like it, share it, subscribe, and let's be social. You can find me everywhere, Makeba Evans, on Instagram, Twitter, Facebook. You can find me on Clubhouse, and I would like to connect with you. All of our pertinent contact information is below, whether you're looking for a real estate agent, myself, or a mortgage professional, Art Wood. Reach out. We don't mind sharing, answering questions. Leave your comments. I'll dip in periodically to answer those for you. Make sure you check out episode 2. Have a good one. Peace.